Mark, really good to see you. Today, we're going to talk through three strategies to minimize your Social Security taxes. Many retirees are surprised to learn that above a certain income, Social Security is taxed. In retirement, of course, it's important to know how all your income streams will be taxed and how to mitigate those taxes. So let's start with the basics. How are those Social Security taxes calculated?
Well, thank you, Aaron, and thank you so much for having me here today. Social Security is a really interesting topic, and we have as a retirement income, it is a very important cash flow. The challenge today is, the taxation of Social Security, and there's a lot of confusion around it. Just to give you a bit of history, the first bracket that came out, which you can see is this up to 50% of your Social Security can become taxable. That started in 1984. And actually, that was a government law that was passed to pay for the trust fund being depleted back in
Mm.
84. And then you go to 1994, 10 years later, and then they had another bracket created that was the 85% bracket. Interestingly enough, neither one of these brackets have been adjusted for inflation. But you can see if you're a married filer, any of your income, this is taxable income earned or unearned over 32,000 is going to become up to 50% is going to be taxable. And then once you exceed 44,000 up to 85%. Obviously, if you're a single filer, it's less. 25,000 is the threshold, up to 34,000, and then anything above 34,000 up to 85% of that benefit becomes taxable.
This is interesting, Mark. Thanks for that history because it is, I love learning more about Social Security because it's always a moving target. But again, as we talk about those taxes, they are based on your provisional income. So, what makes up provisional income?
Yeah, so interestingly enough, a lot of people just think that Social Security is just going to get taxed as ordinary income, but it actually has to go through a different formula. It's
Mhm.
called provisional income. And think of it like a tax on top of a tax. But what we have to do is we have to take half of the Social Security benefits that are coming into the household. So let's say that's 50,000 total benefits. So we'd start out at 25,000, and then we would add to that all of our taxable income. Now, this could be IRA distributions, it could be earned income, it could be from required minimum distributions, capital gains, interest on CDs, whatever is taxable, earned or unearned. And in addition to that, actually, municipal bonds, even though the interest we receive on those is tax free, they are included in that provisional income calculation. So,
Interesting.
so let's just say I have 25,000 of Social Security benefits, and I add up all my provisional income, and it's 25,000. So my total or my provisional income in my example would be 50,000. So in either case, obviously more of that Social Security benefit is going to be flow over to my 1040 and become taxable.
Wow. Interesting. Okay, so now let's talk through those three strategies then to reduce your taxable income. And the first strategy that you are recommending is consider converting all those taxable accounts to Roth accounts. And this is because, again, we look at this little puzzle piece, Mark. Your biggest liabilities are those 401ks and IRAs.
Yeah, and the thing is, if you're going to convert to a Roth IRA, you have to have a belief that tax rates are going to go up.
Hmm.
Now, there are some in the government. In fact, you can reference David Walker, who was the chief comptroller for the Bush or actually from 1998 to 2008. He basically was the head accountant. And he says, look, it's the math. The math is going to suggest that tax rates have to double. So before you do any kind of conversion, you have to believe that tax rates are going to go up. But a lot of people will be in a better position even if they convert and tax rates don't go up. So if we convert, we're paying taxes now when tax rates are very low. And if you look at it historically, we are in the lowest tax brackets
Right,
we'll probably be in our lifetime.
right.
So essentially, taxes are on sale. But really, what we'd have to do is we have to do a little bit more planning because there's really 6 different ways to do Roth conversions or take advantage of that. So in our practice, we call it let's create a tax roadmap because we want to bracket bump. And if you think about it, the 24% tax bracket has a tremendous amount of room where, you go back to 2017, you had very little room. So ultimately we could be bumping up against that next bracket, taking advantage of the full bracket and converting. The challenge obviously is, where do we pay the taxes from? And it's either going to have to come out of the investment itself, or if we have a large brokerage account, we can pay from that to pay those taxes.
Mm-hmm.
The taxes aren't going away. It's just when you choose to pay the taxes. And I'd rather pay the taxes on my terms or my client's terms rather than the government's terms.
Of course. Of course. And I think some of your answer there leads us into strategy number 2, which is consider shifting income investments. Some investments generate taxable income, others are non-taxable.
Yeah, so a lot of people will have large brokerage accounts in conjunction with large tax deferred IRAs. And our suggestion would be, and it doesn't have to be this way exactly, but you really only need the brokerage account to have you should have it as your emergency fund, and you shouldn't have more than 6 months of income, because again, when you add in Social Security, then you've got capital gain taxation, interest income. All of these things are pushing more of those Social Security benefits into the provisional income, ultimately creating more tax liability for you. And here's the other challenge is a lot of people have been really good savers. So ultimately, when they get to required minimum distributions, which is now age 73, and then if you were born after 1960, it's now age 75. Now they've delayed that, they've deferred it, but you're just deferring the cancer or the taxes longer. So ultimately, before tax rates go up, and they're slated to go up in 2026, now they could kick the can down the road maybe another 4 years, but we have a window of opportunity to really look at this and reposition and shift those assets into the appropriate buckets that are really going to benefit us.
Mm-hmm. And the third strategy you recommend is simply to delay claiming your Social Security benefits.
Yeah, so if you think about it, a lot of people have saved their entire life. So their entire mindset is around accumulation of wealth.
Mm-hmm.
And a lot of people would rather claim Social Security at an earlier age. But again, they didn't understand the tax issues that they're now going to be faced. Here's the other thing. If you're married and you take it early, well, now you have a permanent reduction in that spousal benefit.
Right.
But the benefits are growing at guaranteed rates of return. So again, if we go, hey, let's draw down our tax deferred accounts first while tax rates are low, do some conversions along the way, defer Social Security a little bit longer, then we're increasing our cash flows from Social Security, hopefully mitigating the taxation, and we're not losing the spousal benefit by taking a lesser strategy than when we were younger.
Mm-hmm. Clearly, a very complicated equation that needs to be personalized to each person. But the one thing I'm hearing, Mark, is the sooner you can start preparing, the better. So if somebody wants to talk through these strategies today, again, because we are in a historically low tax rate, what's the best way to reach you?
Yeah, the best way to reach us is 2 ways. One, obviously give us a phone call. The phone number is 303-681-0113. It's easy enough to schedule an appointment with someone on my staff. And then if you want to, you can also go to our website. It's mcgregorwealth.com. And by the way, we've got some upcoming workshops that we're really focusing on Social Security, taxes, and those sorts of things. So I think what I would encourage people to do is, give us a call. Our role here is to help educate you. But either way, get educated in this, because the tax train is coming and tax rates are going to go up.
Lifelong implications. Mark, thank you so much for your time today.
All right. Thank you, Aaron. Have a wonderful day.